Hi, I'm Kenton, and this is Kenton Knows. In this video, I'm going to explain the steps I go through when analyzing investment properties to purchase, including all the numbers I use and how I determine what they should be for each property. If you like this video, please hit the like button, leave me a comment, and consider subscribing to my channel. I'm going to try to make this as simple and clear as I can while explaining each component that goes into my calculations. I prefer to do my calculations with a spreadsheet so I can see each item. I don't use any of the calculators or apps to make a property investment decision. I self-manage my properties, so I won't have a management fee, and I do a lot of my own maintenance, which keeps my maintenance costs very low as well. I manage my properties as a holistic business, which means that even though each property is in its own LLC, I don't keep large reserves in each LLC, but will transfer money into one LLC from another or my personal account if there is a cost that exceeds the income that month. Since all of my properties have a positive monthly cash flow, that is a fairly rare occurrence, but it does happen. I did a full video on how I manage my reserves and the rationale behind why I have minimal reserves. I also will not be talking about your taxable income versus your net income or any other tax consequences. The reason I'm leaving that out is that you only pay taxes if you make money. And even though depreciation and your various tax deductions may reduce your taxable income to zero, which is great, that shouldn't be a determining factor in deciding whether to buy a particular property or not. The calculations I will walk you through should help you determine if this specific property will have a positive net cash flow that makes sense for you before taxes. Yes, we can run a lot of numbers and calculations on your anticipated long-term return, but they're all extremely dependent on guesses you are making about future rent growth, property values, interest rates, and all of the various expenses. If your assumptions are just a couple % off and you compound it over many years, you will get an extremely distorted view of the expected performance of the investment. So, for small investors without a lot of experience and historical data, I don't think that type of analysis is worth your time. Instead of guessing the growth rates, I'd recommend only looking at properties that, in your opinion, are located in areas where the demand for housing is growing. As long as you believe that the rental property you are buying will continue to be in demand for years to come, you should see your rental income grow at least as fast as your expenses. That is one of the main criteria I look for in an investment property before actually doing the calculations. I need to believe in the location of the property and then ensure that the finishes meet the needs of the renters today and into the future, which may require upgrades to the property. Personally, I prefer to buy properties that need to be gut renovated in areas that are growing in popularity. By doing that, I know that I have addressed all of the electrical, plumbing, and HVAC issues, as well as adding in-unit laundry and any other amenity that I believe higher-end tenants will expect. The calculations are a little more complicated as I do need to add in the cost of the renovations and the carry cost while not having any income during the renovations, but I believe you can get a higher return by adding value to the properties you buy. I will do a follow-up to this video to explain that process in more detail. Now, let's talk about what my threshold is for determining whether to pursue a particular property or not. To determine my threshold, I believe in considering all of your investment options for your money. So if I can expect a return of 8 to 10% in the stock market without doing any work, then I expect my real estate investment to make at least a 10% cash-on-cash return based on my initial investment. Plus, I expect to boost that return with property appreciation, principal paydown, rental increases, and all of the tax deductions real estate entails. The combination of those factors will ensure that I have an actual return significantly higher than 10%, but I need to start with that as my baseline. The other thing to consider is, what is your time worth? If you buy a property for $100,000, your initial investment may be $20,000. And if you receive $2,000 in net income, you are getting a 10% return on your $20,000 investment. But unless you expect the property to appreciate considerably in the future, I wouldn't do that deal, as I know the time it takes to manage a property, and $2,000 in net income is not enough for me to take on that project. But you will need to determine what makes sense for you and your opinion of the future prospects for that area. Or if it is your first property, that might be a great one to start, as the lower cost also means you have more room to make mistakes without suffering a major setback, since you are going to be learning a lot on your first deal even if you don't make a lot of money on it. So my threshold is a 10% cash-on-cash return and whatever number I need to make per year to make it worth my time to manage a property. For me, that is currently at least $10,000 per property in net income. This may change if I believe I will be taking a majority of my money out after refinancing in the first year, but I'll discuss that in a follow-up video as well. Let's dive into how I actually run the numbers on a property I am considering buying. For simplicity, I will break it into 4 main areas: purchase, costs, income, and analysis. To make it easier to understand, I will be showing the numbers I used on my last duplex purchase. But in practice, I usually run the numbers with an expected scenario and a worst case scenario with the same formulas. For the worst case, I would put the lowest rents and the highest interest rate I could foresee just to stress test the purchase. I like to see how my final return may change if the interest rates jump or I blew an assumption. But for this video, I'm just going to do one column with the actual numbers for this deal. Here is the purchase section. The purchase price was $352,000 and I was able to get a 75% loan to value ratio for this purchase. So the loan was for $264,000 with a down payment of $88,000. Closing costs were $7,000 and repairs would be about $5,000. So my total investment for the purchase was $100,000 and the total loan value was $264,000. I knew what my loan to value ratio would be after talking with a mortgage broker I've worked with in the past, and I have a few I highly recommend in the description of this video. Closing costs actually vary by your area, so if you haven't bought anything in the area, a quick Google search for your city or just talking with your lender should give you an estimate. Probably between 1% and 3% of the purchase, but you should be aware that in some areas there may be significant credits from the seller for prorated taxes if you're buying in an area with higher taxes, as I do in Chicago. For this property, I knew that I would need to do around $5,000 worth of work in the first floor apartment, so I added that as an initial cost. If you are unsure about this number, I'd advise you to guess to start, and then if you're fairly certain you'll be moving forward, you should bring in a contractor to give you a better estimate if possible. Next, we move on to the cost section, which are all monthly costs. The mortgage is a simple calculation from the loan value above and the interest rate you believe you will get. For this property, I purchased it at a 5.75% interest rate, but when I ran my numbers, I also ran it at 6 and 6.25, just in case rates changed to see my interest rate risk. The property taxes should be on the listing, but a word of caution here, as I don't always trust the listing. It is fine to start with the listing, but if you are seriously considering making an offer, I would go to the county website and look up the taxes for the property. I would confirm the taxes are correct and also look to see if the current owner has any exemptions that are keeping them artificially low. In some areas, there may be a homeowner exemption or a senior freeze, and you don't want to base your calculations on a tax number that may jump dramatically after you close. Next is your insurance, and I'd recommend calling a few insurance brokers to get a couple of quotes. For utilities, you'll need to see how many meters are on site and determine if there are any common utilities or if the tenants pay them all. For this particular property, there's a common electric meter, but the tenants pay for their own electricity in their units. The water bill is for the building, so I will pay that, and I can guess that based on the other properties I own. For gas, each unit has their own gas meter, but there is not a common gas meter, so that is zero cost to me. Garbage is shared for the property, so I will pay that as well. The total monthly costs are $2,453 for this property. If you're unsure about estimating any of the monthly costs, I would ask the seller for bills or a disclosure for the utilities. Here is the income section. Since this is only a duplex, it was fairly simple. I have a video on how to determine your rental rates, and since I actually have 2 other properties within a few blocks of this one, I was fairly certain what rents I could achieve. Based on that information, I was confident with an income of $3,580. Now, on to the analysis section. To get the annual income and costs, I just multiplied the monthly numbers by 12. Then, the net annual income is the difference between the two. Next, I carry the initial investment number from the purchase section and put it here so you can see it. Then, the cash-on-cash return is calculated by dividing the net annual income by the initial investment. So you can see that this deal had a return of 14% and an annual income of about $13,500. Again, my threshold is that the cash-on-cash return be over 10% and the net annual income be over $10,000 for me to pursue the property. So this deal met my criteria and I moved forward with the purchase. If the return isn't meeting your criteria, don't play with any of the numbers. other than the purchase price. You simply need to reduce the purchase price to reach your threshold. Being overly optimistic by hoping for higher rent or finding a way to reduce your repair costs will most likely get you into trouble. The purchase price is really the only area to look at here, or if mortgage rates drop some, that might also make the deal work. Now, I know I'm going to get a bunch of comments with people asking why I don't have vacancy, maintenance, and capital improvements included in my numbers. You may want to add them to your analysis if it makes you feel better, but I'll explain why I don't, and you can decide what is best for you. First, I bought my first apartment building in 2003, and I haven't had any vacancies. Do you think I'm just lucky? No, I'm not lucky. It's a business, and you need to understand how you run your business. When you own a property, you are committed to making the best decision for that property. And as the market changes, you need to change with it. There are not any other options. Apartments are your assets, and when they aren't rented, you are losing money that you will never get back. Here's the calculation that should help you understand why you should never have vacancy. Start with an apartment that rents for $2,000 or $24,000 for the year. You miss 1 month and your annual income goes down to $22,000 or the equivalent of $1,833 per month. So if you can't rent your apartment for $2,000, then drop the rent. Anything over $1,833 is better than missing a month. Rents are not going to magically increase in a month or two to make up for that lost month. Just drop the rent and get it rented. You will rarely need to drop the rent the full 8.3%, which is the equivalent of missing a full month's rent. On top of that, when you add vacancy to your calculations, you are effectively reducing your rental income. So if you are including aggressive rental rates in your calculation, then vacancy may bring them back in line. But if you are conservative in your rental rate estimates, then adding vacancy makes them even more conservative. So I see no point in adding a vacancy line to my purchase analysis when I'm already using conservative rents. Second, let's talk about maintenance and capital improvements. I personally did most of my repairs until my portfolio grew large enough to support a maintenance person, which is essentially built into all my properties now. So the labor is negligible, and the materials are all fairly inexpensive. Most normal repairs are blinds, lights, appliance parts, and painting, none of which are really a big deal in terms of material. I have a video on how much to hold in reserves, and I detail exactly why I don't budget or save a lot for maintenance or capital improvements each month. In this example, I have a net income of $1,127 per month for this property, which should more than cover any normal maintenance item, including a furnace repair each month. It won't cover bigger capital improvements, but for those, I can either use the income from another property to cover it that month, or I can use my home equity line of credit. Normally, I know that something is nearing the end of its useful life, like a roof, well in advance of it failing, so I can set aside some money for it, but again, the line of credit will work if needed. Yes, these additional costs can eat into your return, but that's the nature of this business. If you buy properties in areas that are generally growing, then the property value and the rents should increase at least as fast, but hopefully faster than your costs, which means that any of these bumps in the road are just that, bumps along the way while your income and wealth grow each year. Real estate is a long game, so you don't want to overload your analysis with so many what-if scenarios that you never end up buying a property. If you do build in any extra contingencies for any of these items, just be aware that a furnace or hot water heater costs the same, regardless of whether you are getting $500 or $2,500 in rent. So saving 2% of $500 will only amount to $120 for the year, where saving 2% of $2,500 will be $600 for the year. So be very careful with percentages if you decide to include them in your analysis. If you like this video, please hit the like button and consider subscribing. If you have any questions, please feel free to ask them in the comments below. If you found this video useful, please like and share it with someone else who might enjoy seeing it. I'll also work on a follow-up video on how I did a little more analysis on this property before buying it, knowing that I would be doing a cash-out refinance in the near future. Thank you for watching Kenton Knows, and I wish you the best of luck with all of your real estate investments.